Hello, and thank you for the opportunity to speak to you today. I'm Taylor Prost, an Associate Chief Accountant in the Professional Practice Group, or PPG, within the SEC's Office of the Chief Accountant. Sorry, that's a mouthful. And I'm joined by Shauna Wolfson. Shauna, would you like to introduce yourself?
Sure. My name is Shauna Wolfson, and I'm also an Associate Chief Accountant in PPG. We'd like to once again thank you for providing us with the opportunity to speak at this event. Taylor, before we begin, could you please provide us with our standard disclaimer?
Sure. We do have to give the standard disclaimer that our remarks today are provided in our official capacities in the Office of the Chief Accountant, but do not necessarily reflect the views of the Commission, the Commissioners, or other members of the Commission staff. As always, I thought maybe we could start by providing a brief overview of the Office of the Chief Accountant. My apologies to those who've heard this information before. The Office of the Chief Accountant, or OCA, not to be confused with the PCAOB's Office of the Chief Auditor, is the principal advisor to the Commission on matters of accounting, auditing, and auditor independence with respect to the application of federal securities laws. OCA is comprised of approximately 50 individuals who have a broad mix of experiences with various professional backgrounds who work in support of high-quality financial reporting in both domestic and international capital markets. OCA's priorities are anchored to the SEC's overall mission and strategic plan, and our focus is and always has been on promoting high-quality financial reporting of our registrants for the benefit of investors. Our office is divided into four major groups: accounting, professional practice, international, and our Office of Chief Counsel. Shauna, would you like to walk us through the responsibilities of the four groups within OCA?
Sure, Taylor. The accounting group leads the SEC's efforts to oversee accounting standard setting by the FASB, the Financial Accounting Standards Board, and to monitor international accounting standard setting by the International Accounting Standards Board, or IASB. In conjunction with the Division of Corporate Finance, the accounting group issues staff accounting bulletins, or SABs, that inform the public of the staff's views on important accounting issues. The accounting group also consults with registrants, auditors, and other commission staff regarding the application of accounting standards and the financial disclosure requirements. Our professional practice group, or PPG, the group where Taylor and I work, provides expert advice related to accounting, auditor independence, and internal control. PPG also assists the Commission in its oversight of the PCAOB, primarily through oversight of PCAOB rulemaking and standard setting, inspections, and the PCAOB's annual budget. Additionally, PPG manages the resolution of auditor independence and ethical matters that have been brought to the Commission's attention. The International Group provides advice to the Chief Accountant on international auditing and accounting issues and collaborates with OCA's accounting and professional practice groups to provide governance and technical input to international accounting, auditing, and regulatory organizations that share similar financial reporting objectives as the Commission. Lastly, our Office of Chief Counsel, or OCC, provides legal guidance to the Chief Accountant and other OCA groups to support the Commission's mission. In addition to extensive work in rulemaking and other legal policy matters, OCC supports the Division of Enforcement in all aspects of its programs related to financial reporting, including recommending disciplinary actions against accountants and accounting firms brought under Rule 102E of the Commission's Rules of Practice. Overall, OCA is a service office and supports other divisions and offices in the Commission in a variety of capacities, from rulemaking to enforcement matters. Taylor, perhaps you could provide your insights into OCA's role in overseeing the PCAOB.
Sure, I'd be happy to. In general, OCA supports the Commission in its oversight of the PCAOB in various ways. Our oversight activities include supporting Commission appointments to the PCAOB board, and OCA also supports Commission efforts to consider and approve new PCAOB auditing standards and rules, supports the Commission's annual review and approval of the PCAOB budget, and oversight of the PCAOB's inspection program, just to name a few. With respect to rulemaking and standard setting, for those unaware, once PCAOB rules and standards are approved by the board, such as the recently approved QC 1000 and AS 1000 standards, which were approved on May 13th, a final approval by the Commission is required in order for the rule or standard to become effective. We facilitate the Commission's review and, as appropriate, approval of those standards and board rules. OCA staff work closely with the PCAOB to review proposed standards, comment letters received, and other information submitted by the PCAOB. We also hold discussions with the PCAOB staff around a variety of areas related to the proposals, including how the board considered the key themes identified by stakeholders during the public comment periods. We then make recommendations to the Commission regarding the approval of the standards. We also support the Commission's oversight of the PCAOB's inspection program. Section 104H of SOX provides for the right of a registered public accounting firm to request an interim commission review with respect to a PCAOB draft inspection report under certain conditions. Although few and far between when we do receive such requests, they typically come in the form of Part 2 publication challenges or comment form challenges, Part 2 relating to areas of quality control. SEC's Regulation P, which details the SEC's procedures with respect to its oversight of the PCAOB, lays out the procedures for firms to follow in requesting an interim commission review with respect to a PCAOB inspection report, including examples of the types of information that should be included to the extent possible in the request for the Commission's review. Based on this information, the Commission, as facilitated by the Office of the Chief Accountant, considers whether the PCAOB's assessments or determinations were arbitrary and capricious or otherwise not consistent with the purposes of SOX. Shauna, keeping with the theme of our priorities, I thought we might highlight some key reminders that have been top of mind in our office that might be relevant for this group. Perhaps we could start with our Chief Accountant Paul Munter's recent statement on professional skepticism and audit quality. Any key takeaways from that we could share?
Sure, Taylor. I'll highlight some of the key thoughts as it relates to auditors' professional skepticism. At the core of auditing, regardless of the complexity of the audit area, is the auditor's responsibility to exercise professional skepticism in all aspects of the audit. That logically extends to judgments and estimates related to fair value or contingencies, among others. In February, Chief Accountant Paul Munter released a statement, an investor protection call for a commitment to professional skepticism and audit quality. In this statement, we described helpful best practices to consider how best to put on that professionally skeptical hat. First, the auditor should frequently and proactively engage with audit committees, which for listed issuers must be independent. These discussions should include events that impact financial reporting and related issues, including any red flags arising from management responses. Second, the auditor should consider using specialists and other experts to assist in auditing complex areas or areas where specialized knowledge is needed. Doing so will help ensure that the auditor has adequate expertise to challenge management's assessments and assertions. As a reminder, the auditor still has various responsibilities under PCAOB standards when using the work of a specialist or expert. Thirdly, the auditor needs to make sure that engagement teams are appropriately trained on biases that can affect auditor judgment and decision-making. Finally, the audit firm and the lead engagement partner have a responsibility to establish a tone at the top and a culture that empowers the staff to exercise professional skepticism and challenge the judgments of management. We have been encouraging audit partners and firms to be explicit with the staff who provide support, urging them to probe areas of heightened risk and red flags, to keep asking questions until they're comfortable, shielding staff from any undue internal or external pressure to accept less than persuasive audit evidence, and rebuffing management requests or demands to replace audit team members.
Thanks, Shauna. It'd be helpful to maybe dive a bit deeper and provide some specific considerations around auditors' responsibilities for risk assessment. So I'll touch on those. I'd like to share a concept we've been discussing a lot over the past year. So you might have heard this in other speaking engagements, but it's what we're referring to as a skillful audit approach. So speaking at a level of generalities, there are really two ways in which accounting firms approach auditing. First, there's the limit approach. This is where an audit firm does a check the box audit, planning and conducting procedures based on what it does not need to review, performing the bare minimum to support the conclusion in its audit report. And while not always intentional, the limit approach can be an easy trap to fall into given the prescriptiveness of existing audit methodologies. Second, there's the skillful approach. This is where auditors focus not only on what they're minimally required to do, but also on what they should review and inspect, and thereby engaging in a robust iterative audit process that supports high quality, reliable financial statements upon which investors place their trust. So I'm sure this concept will resonate with this group. So I challenge everyone to step back at various points throughout the audit and ask yourself which approach you've been following, the limit approach or the skillful approach. Some ways that we've seen the importance of the skillful approach over the checklist approach include a limits approach may lead an auditor to focus on an entity's direct financial reporting risk too narrowly, rather than taking a skillful approach and understanding that many items may have an indirect but important impact on financial reporting risks. For example, auditors may default to assessing a regulator's findings as outside the scope of financial reporting. However, when considering the root cause of such findings, especially in cases where there are multiple related findings, there could be an impact on management's conclusions regarding the effectiveness of internal control over financial reporting due to their impact on the risk assessment and monitoring components of ICFR. As another example, regulatory findings or tips being investigated by the company may indicate a lapse in ethical behavior, whether directly or indirectly related to financial reporting, and may represent a tone at the top issue that should be considered in the auditor's fraud risk assessment and evaluation of entity-level controls. Auditors should assess the consistency of information disclosed by issuers and the judgments made by management throughout the financial reporting process with other information, such as the company's public statements or other publicly available information like short seller or analyst reports. Any material inconsistencies may indicate the existence of a potential new or evolving business risk that could materially affect the financial statements or the effectiveness of ICFR. Too often, auditors may rationalize away disconfirming evidence rather than applying objective judgment and professional skepticism when evaluating such evidence. A good example of applying these concepts around professional skepticism and risk assessment relates to evaluating materiality of errors. Sean, are there materiality reminders that you'd like to highlight from an audit perspective?
Sure, Taylor. OCA's accounting group continues to receive consultations around materiality of an error in a previous reporting period. Assessing whether an error is material to prior periods is not a mechanical exercise, nor should it be based solely on quantitative analysis. Rather, management needs to thoroughly evaluate the total mix of information, taking into consideration both quantitative and qualitative factors, such as whether a measure is relevant to financial statement users, to determine whether an error is material to investors. Ultimately, the materiality evaluation needs to be an objective evaluation, taking into consideration all facts and circumstances with respect to the error. If the registrant determines that previously issued financial statements are materially misstated, those financial statements would need to be restated and reissued. By comparison, if the error is not material to previously issued financial statements, but correcting the error in the current period would be material, an entity is not precluded from correcting the error in the current period comparative financial information by restating the prior period information and disclosing the error. This is commonly referred to as a little r revision restatement. In this instance, I think it's important to note that this still constitutes an accounting statement. We also frequently find ourselves in conversations with registrants about the materiality analysis, and we find it useful to consider the guidance in SAB 99. In particular, the orientation of the SAB speaks to circumstances where a quantitatively small error could, nevertheless, be material because of qualitative factors. In many cases, we're involved in discussions arguing the reverse, that a quantitatively significant error is nevertheless immaterial because of a qualitative consideration. A careful, well-reasoned, holistic, and objective evaluation is needed when determining whether an error is material, and if it is material, whether correction needs to be handled through a big R or a little r process. I'd like to highlight that the statement of cash flows has consistently been a leading area of restatement. However, we've observed that a significant majority of these restatements are little r revision restatements. In certain instances, the OCA staff have been presented with analyses that conclude an error in the statement of cash flows is not material because it's only a classification error. We have not found such arguments to be persuasive, since classification itself is the purpose of the statement of cash flows. A recurring theme in the topics we've discussed today is materiality. Whether it's the auditor's assessment of material items in their risk assessment, or management and the auditor's assessment of materiality of errors, it seems like materiality underpins all critical aspects of financial reporting and auditing. Taylor, could you highlight a few thoughts on this topic?
Sure. So our chief accountant, Paul Munter, released a statement in March of 22 that focused on materiality and grounded the concept in Supreme Court cases Basic v. Levinson and TSC Industries v. Northway. The Supreme Court has held that a fact is material if there is a substantial likelihood that the fact would have been viewed by a reasonable investor as having significantly altered the total mix of information made available. So let's pull that statement apart a bit to really understand how it can be applied. What does the total mix of information mean practically? First, I would say it means not limiting your analysis to the accounts or even the financial statements that are directly impacted. What other impacts may the error have that would be part of the total mix of information that an investor is considering? Secondly, I think the concept of total mix means not limiting the analysis to the direct quantitative impacts, but also considering the qualitative impacts. A quantitatively small error could change net income to a net loss. Evaluating the error with a very narrow view on just the monetary amount may lead to a conclusion that it's immaterial rather than taking a total mix approach and understanding the larger impacts and other communications by management. And while that may be a more extreme example, it's not uncommon for smaller monetary errors to have a quantitatively larger impact on trends and other key performance indicators that are extremely relevant to investors. Additionally, in thinking about the qualitative aspects of a misstatement, one of the key considerations is whether it is the result of an error or fraud. This consideration also may lead to an assessment of other risks of fraud in the financial reporting process. These concepts have always been important, and we're seeing even more attention being placed on this analysis now that the SEC's clawback rules are in effect. As I'm sure everyone in this room is aware, certain payments to executive officers that were based on company performance may be required to be clawed back when previously reported amounts are restated. Given these potential incentives to determine amounts to be immaterial and thus not restate the prior period, the concepts grounded in the Supreme Court opinion serve as foundational guardrails. Speaking of the auditor's gatekeeping role, independence has been an ongoing priority of OCA. Shauna, would you like to share some thoughts and reminders on auditor independence?
I'd be happy to, Taylor. First, I'd like to remind everyone that independence is a shared responsibility between the auditor, management, and the audit committee, or those charged with governance. Each party has a critical role to play, and none of these parties should assume that others are completely responsible for monitoring independence or any issues that may arise. To provide a quick refresher, the general standard of auditor independence, Rule 201B, is the heart of the Commission's auditor independence rule. It establishes the threshold of the reasonable investor perspective. The remainder of the Commission's auditor independence rule, beginning in paragraph C, consists of a non-exclusive list of circumstances that are inconsistent with the general standard. As a general observation, OCA staff have seen situations of decreased vigilance when it comes to auditor independence, specifically of a checklist or limit mentality, which Taylor touched upon earlier. This presents itself as a focus on how close to the line a firm can go without having a per se violation, or a focus on not violating the specific prohibitions outlined in Rule 201C. Compliance with the prohibitions in Rule 201C is necessary, and it cannot be effectively executed as a checklist compliance exercise. This type of tone at the top has the potential to erode the ethical culture of a firm. I'd also like to point out that the line formed by SEC and PCAOB independence rules is a compliance floor. In recent years, the Commission has brought several actions against auditors, alleging violations of the general standard. This highlights the importance of the Commission's general standard, or reasonable investor test, as a means to address the myriad of ways in which independence may be impaired beyond the list of specific circumstances addressed in Rule 201C. Taylor, does the staff have any advice to those charged with governance and management as they consider independence?
Great question, Shauna. So we continue to encourage those charged with governance and management to consider the sufficiency of the auditors and the issuers' monitoring processes, including processes that address corporate changes or other events that potentially affect auditor independence. Audit firm monitoring needs to be vigilant to ensure the firm understands and assesses not only its clients' affiliates, so that it doesn't enter into prohibited relationships with or provide prohibited non-audit services to existing or potential audit clients, but also independence considerations stemming from the audit firm's corporate or business structure. In the current environment, we continue to see accounting firms seeking to access public markets through new and innovative transactions, including some recent audit firm consolidations driven by private equity investment. When a private equity or PE firm or others invest in a portion of an accounting firm. These transactions are commonly referred to as alternative practice structures or APSs. Shauna, could you please walk us through the types of APS transactions we're aware of and explain some of the independence or potential independence implications?
I'd be happy to do so. In August 2022, our chief accountant, Paul Munter, issued a statement regarding critical points to consider when contemplating an audit firm restructuring, which focused on these types of transactions. Since the release of this statement, we've seen an uptick in audit firm restructuring, including APSs. I'll touch upon some of the relevant independence considerations in these transactions. Each entity within the PE group structure needs to be carefully evaluated to determine whether the entity is an associated entity, making it part of the accounting firm for purposes of assessing potential impacts on auditor independence. Recently, the most common APS structure that we've seen is one in which the attest and non-attest practices of an accounting firm are split into two separate legal entities. One or more private equity or other investor groups acquires a non-controlling interest in the non-attest practice, while the legacy audit firm partners retain a non-controlling interest in the non-attest practice. The non-attest practice assumes most assets and employees of the legacy accounting firm. Then the attest practice leases personnel and assets it needs to operate and meet its professional obligations from the non-attest practice through an administrative services agreement. The attest partners are also employees of the non-attest practice. If a private equity group controls the non-attest practice of one or more accounting firms, the attest practice of the accounting firms may be under common control of the overall PE group, regardless of whether they are in different funds or have different general partners. Commission staff believe that a reasonable investor could consider such accounting firms to be associated entities with each other. Even in circumstances where a PE group does not control the non-attest practice of an accounting firm, we believe that a reasonable investor would likely consider the accounting firms that are associated with the private equity group to be associated entities based on certain facts and circumstances. For example, if the private equity group has investments in more than one accounting firm, and the private equity group has the same representatives on the governing body of both non-attest entities. Regardless of confidentiality agreements and the like, such individuals who are on both governing bodies could have the ability to exercise influence and are likely to have significant influence or even control over one or more of the accounting firms. Paul Munter's 22 statement also addresses the General Standard of Auditor Independence, Rule 201B, noting it would be a high hurdle for the accounting firm to be in compliance with Rule 201B if it provides any audit, review, or attestation services with a nexus to the Commission's independence requirements to any entities within the private equity structure. Finally, I'd like to reiterate that these are complicated transactions. APS structures expand the number of entities that an accounting firm will have to maintain independence from under the SEC independence requirements. Establishing robust and appropriate independence controls and processes is very important, and operating in an APS could increase the challenge of doing so exponentially. Irrespective of the corporate structure in which an accounting firm chooses to operate, an accounting firm will continue to be responsible for maintaining its independence for all audit clients that have a nexus to the SEC independence requirements. As always, OCA staff have a consultation process for independence matters. If audience members are involved in or otherwise advising on these types of complex transactions or any other independence matters, the staff are available for consultation regarding your specific facts and circumstances.
Thanks, Shauna, for the reminders on the importance of maintaining auditor independence. I think this segues nicely into a few points I wanted to make about accounting firm culture and governance. Auditors play an important gatekeeper role, as I mentioned earlier, that supports high quality financial reporting to protect investors. Auditors are required to comply with ethics standards, and we should challenge ourselves to consistently maintain ethical mindsets and behaviors that underpin the lasting value of our professions. It is of paramount importance that firms foster a culture of ethical behavior with respect to all aspects of their professional responsibilities. Any perceived erosion of the profession's ethics or integrity breaks down the critical role of our professions and can, over time, lead to diminished investor confidence. We've been troubled by recent scandals that highlighted a culture centered around generation of revenue with a growth at all costs mindset. More generally, we're concerned about a potential shift in audit firm strategy that de-emphasizes audit quality and fidelity to the public trust in favor of revenue generation. To preserve the critical gatekeeper role that auditors play in serving the public interest and fulfilling an investor protection mandate, audit firms should lead by example. They should, for instance, prioritize auditor independence and a culture of ethical behavior in all professional activities. And where independence on an audit engagement is a close to the line call, firms must be willing to forego audit fees or potentially lucrative restructuring proposals to comply with their independence responsibilities. As you know, most of the more eyebrow-raising matters we've seen implicating a deficient tone at the top have been on the issuer side. However, we've seen some very serious enforcement matters addressing those deficiencies at accounting firms as well. The varied cheating scandals from the past few years may come to mind for many of you. In these scandals, audit professionals cheated on CPA ethics exams or internal training exams that were part of continuing professional education and/or training mandated by an earlier SEC order finding audit failures. To date, the Commission has brought large enforcement settlements involving accounting professionals cheating, and the PCAOB has brought enforcement settlements involving similar cheating related misconduct. This past year, we've also seen problems stemming from accounting firms' senior leadership's prioritization of growth, which exacerbates deficiencies in the firm's underlying quality control policies, procedures, and monitoring. For instance, over a 3-year period, one firm more than tripled its number of public company clients. According to a recent settled order involving that firm, it repeatedly failed to comply with audit standards related to audit documentation, engagement quality reviews, risk assessments, audit committee communications, engagement partner supervision and review, and due professional care. Depending on the auditing standard at issue, violations were found in 25 to 50% of audits reviewed, with even more frequent, nearly wholesale violations found across the firm's SPAC practice. This may be an extreme example, but what message does this send to the investing public regarding their trust in audits if accounting firm personnel are shirking basic compliance tasks or the most fundamental of auditing standards? These themes around audit firm culture and tone at the top are also highlighted by our chief accountant, Paul Munter, in a recent statement published on May 15th. As you can probably tell from our discussion, Paul enjoys his statements, and we'd highly recommend staying up to date on those as they are intended to be helpful in highlighting concerning trends, emerging risks, and reminders for auditors, among other things. Shauna, shifting gears a bit, could you please touch upon how the Division of Enforcement supports the Commission's mission of protecting investors to instill public trust and any learnings from recent enforcement actions? For this audience in particular, I think it helps to inform areas of concern to be aware of as you perform your important work in going into the next year's audits.
Sure. As we discussed in the primer on OCA at the beginning of this session, one of the important ways in which OCA supports the Commission is through its support of the Division of Enforcement. Throughout the SEC's enforcement process, our colleagues routinely reach out and consult with OCA on whether potential violations of accounting, financial reporting, or auditing standards may have occurred. This not only protects investors by holding bad actors accountable, but it also informs the standard setting and rulemaking processes. Today, we'd like to share some general observations from recent settled Commission orders. I'll start with another disclaimer that applies to both of us. As we discuss these observations, we're only referring to themes that we took from the Commission's orders. We're not implying that the facts have necessarily been proven or admitted. So far this year, we've seen actions related to both issuers and accounting firms. In one instance, an issuer perpetrated an egregious accounting and offerings fraud through, first, the creation of fictitious invoices, which were provided to the company's auditor and purportedly sent to customers who never actually used the company, then recorded through falsified general ledger entries. And secondly, a scheme to prematurely recognize revenue on service contracts that were not complete or in some cases not started and supported by falsified documents. This reiterates the importance of exercising professional skepticism in the audit, a point we discussed earlier in relation to Paul Munter's statement on commitment to professional skepticism and audit quality. Over the last few years, we've also seen concerning activity involving related parties and related party transactions. Auditors ignoring red flags or appearing to be unfamiliar with securities laws, accounting requirements, or audit requirements regarding related parties and related party transactions. This is another area where professional skepticism is key. But in order to effectively apply professional skepticism, the auditor first needs to understand existing requirements. We also continue to see deficiencies in internal controls and the provision of non-audit services. In this case, an auditor provided financial statement preparation services prior to its client going public. Subsequently, the auditor conducted an audit of the same period under PCAOB standard. However, the previously provided financial statement preparation services are considered prohibited bookkeeping and a management function under SEC independence rules. This highlights the collective responsibility of maintaining auditor independence, including communicating about contemplated transactions in advance and ensuring compliance with the applicable standard setters rules in each scenario. Most recently, the Commission settled an action related to a firm's fraudulent conduct of deliberately and systematically failing to comply with PCAOB standards. Taylor, could you please tell us about this matter and how it emphasizes the importance of firms maintaining a strong ethical culture?
Sure. So this firm failed to comply with PCAOB standards in its audits and reviews of more than 1,500 SEC filings over a 2.5-year period. According to a settled order involving that firm, it failed to adequately supervise and review the work performed by its staff, did not properly prepare and maintain audit documentation, including falsely documenting work that had not been performed, and failed to obtain engagement quality reviews, without which an audit firm may not issue an audit report. The order found that the respondents engaged in improper professional conduct and violated or caused violations of anti-fraud, record-keeping, and other provisions of the federal securities laws. This firm not only put investors at risk, but markets at risk, and also undermined trust and confidence in the capital markets. Because investors rely on audited financial statements when making their investment decisions, the accountants and accounting firms that audit those statements play a critical role in our financial markets. While this may be an extraordinary example, it does drive home the fundamental importance of firm culture and having a strong tone at the top that values ethical behavior with respect to all aspects of their professional responsibilities. Professional integrity is part and parcel of an accounting firm's complete fidelity to the public trust, in the words of our Supreme Court. Audit firm leadership needs to lead other professionals by example, including by holding the audit firm accountable for compliance lapses. These points serve as an important reminder for the accounting profession to ensure it can maintain public trust. One item to note on this front is that the PCAOB recently adopted a new auditing standard, QC 1000, which I mentioned earlier, which covers the quality control systems of accounting firms registered with the PCAOB. In the proposal, there was a significant focus on governance and leadership, including defined roles for critical oversight positions, certifications from the principal executive officer or officers, and the individual with operational responsibility for the QC system, and for larger firm audits, a requirement to have an individual independent of the firm involved in quality control oversight. These changes, in combination with the other requirements of the quality control standard, are anticipated to enhance audit firms' systems of quality control, including their tone at the top and overall governance. Shauna, on a separate note, could you share some reminders to financial reporting related to financial reporting in the current economic environment?
Sure, Taylor. All of our work is grounded in the SEC's mission, including investor protection, and the basic bargain in our federal security law, that investors get to decide what risks they're willing to take, while companies raising money from the public have an obligation to communicate with investors in a transparent manner. In order for this basic bargain to function, companies must provide investors with information that's consistent, comparable, and useful in making capital allocation decisions, while auditors must perform high-quality audits and maintain their independence from audit clients. Management, internal and external lawyers advising management, auditors, and those charged with governance should be focused on communicating material financial and non-financial information that's relevant, complete, and accurate to enable investors to make informed capital allocation decisions. While registrants must operate within the bounds of and comply with applicable rules regarding the form, content, and delivery of information, we must remember that corporate reporting is a communication activity and not solely a compliance exercise. This is especially relevant as the global economic outlook continues to evolve as a result of a number of factors, including rising interest rates, global conflict, and inflationary pressures. These challenges can result in increasing estimation uncertainty for those responsible for corporate reporting. I would remind issuers and those advising them of their responsibility to transparently disclose information about assumptions and material uncertainties in a way that helps investors understand how significant risks and estimation uncertainties affect the financial statements so that they're properly equipped to make informed investment decisions.
That's really helpful, Shauna. Thank you. And I guess when thinking about this upcoming reporting cycle, I also wanted to touch on another hot topic in the reporting and assurance space, sustainability assurance. So I'd like to provide a brief overview of the SEC's new climate rule, particularly from an assurance perspective. As many of you are aware, on March 6th, the Commission adopted final rules to enhance and standardize climate-related disclosures by public companies and in public offerings. The final rules are a continuation of the Commission's efforts to respond to investor needs for more consistent, comparable, and reliable information about the financial effects of climate-related risks on a registrant's business, as well as information about how the registrant manages those risks. The final rules require accelerated filers and large accelerated filers that are required to disclose Scope 1 and/or Scope 2 greenhouse gas, or GHG, emissions to obtain an attestation report over such disclosure. The final rules include phase-in periods. Specifically, the final rules require accelerated filers and large accelerated filers to obtain an attestation report at a limited assurance level beginning the third fiscal year after the GHG emissions compliance date, and require large accelerated filers to obtain an attestation report at a reasonable assurance level beginning the seventh fiscal year after the GHG emissions compliance date. The final rules do not require accelerated filers to obtain reasonable assurance. In addition, the final rules require the GHG emissions attestation provider to be independent and meet certain expertise requirements, the attestation report to be provided pursuant to standards that are publicly available at no cost or that are widely used for GHG emissions assurance and that are established by a body or group that has followed due process procedures, including the broad distribution of the framework for public comment. The attestation report to follow the form and content requirements set forth by the attestation standard used by the GHG emissions provider, the disclosure of certain information by the registrant outside of the attestation report regarding the existence of oversight inspection programs to which the provider or the engagement are subject, and regarding the resignation or dismissal of a former GHG emissions attestation provider and any related disagreements, and the disclosure of certain information by a registrant that voluntarily obtains third-party assurance over its GHG emissions disclosure, including the name of the service provider, the level and scope of assurance provided, and the results of the assurance. The adopting release for the rule contemplated what is considered following due process and what standards are considered widely used. For these and any other questions that may arise in this space, the staff of the Commission's Office of the Chief Accountant is available to consult with registrants or GHG emissions attestation providers. While my remarks today focused on the requirements around the attestation of these GHG emissions disclosures, I did want to mention some other areas that have a nexus to assurance. The final climate rule includes new disclosures under Regulation SK and SX. Auditors will need to perform appropriate audit procedures over the disclosures included in the financial statements. Additionally, current PCAOB standards require the auditor to read and consider disclosures made outside of the financial statements as to whether there are material inconsistencies with the financial statements. Additionally, I want to remind everyone of the current requirements as highlighted by the 2010 Commission guidance regarding climate-related disclosure and financial statements implications under US GAAP and IFRS. Issuers and auditors should remain aware of these requirements. Shauna, there have also been a lot of developments in international sustainability-related standard setting. Could you give our audience an overview of these developments?
Sure, I'd be happy to, Taylor. Even though the dialogue surrounding sustainability reporting may seem more recent, companies began producing corporate and social responsibility reports several decades ago. This practice has become more widespread internationally since the 1990s. with further advances in recent years. Initially, companies, including FPIs, began providing sustainability disclosures voluntarily. Later, when local jurisdictions began to require such disclosures, more companies began providing this disclosure. In response to this over time, several sustainability-related disclosure frameworks have emerged. While investors were gaining insight into a company's sustainability-related risks and opportunities as more information was disclosed, securities regulators have been keenly aware that the information disclosed was often not comparable between companies or across jurisdictions. Companies were either reporting information using different reporting frameworks and/or in compliance with different jurisdictional requirements. In response to this, the International Organization of Securities Commissions, which we refer to as IOSCO, formed a board-level sustainable finance task force of securities regulators to identify decision-useful categories of disclosures for investors and other market participants. During 2021, the IOSCO board committed to working with the IFRS Foundation to develop an effective system architecture for setting sustainability disclosure standards, which led to the formation of the International Sustainability Standards Board, or ISSB. The ISSB issued their inaugural standards in June 2023. In July 2023, IOSCO announced its decision to endorse the ISSB standards and called upon its members, representing more than 95% of the world's financial markets, to consider ways in which they might adopt, apply, or otherwise be informed by the ISSB standards within the context of their jurisdictional arrangements in a way that promotes consistent and comparable climate and other sustainability-related disclosures for investors. Turning now to assurance. A recent survey by the International Federation of Accountants, the State of Play in Sustainability Assurance, found that 69% of companies that disclose sustainability information obtained some level of assurance over that information, and that there was diversity in the assurance standards applied. We continue to see strong momentum around the globe relating to mandatory and voluntary assurance over sustainability information. Currently, some issuers voluntarily seek independent assurance over sustainability-related reporting, often for a subset of information, such as greenhouse gas emissions. In response to this evolving landscape, the International Auditing and Assurance Standards Board, or IAASB, is developing international assurance standards for sustainability information, and the International Ethics Standards Board for Accountants, or IASBA, is similarly hard at work developing standards for ethics, including independence, relating to sustainability reporting and assurance. Both boards have active projects underway and aim to finalize their standards by late 2024. Taylor, is there anything else you want to cover before we wrap up today?
I guess just thinking through some of the important themes that we touched on. We talked about the importance of risk assessment, of professional skepticism, tone at the top and firm culture, auditor independence, and then lastly, I think just a reminder, one last plug for reading Paul Munter's statements. I think we've covered quite a lot, so I think we can wrap it up here, Shauna. Again, I guess apologies that we weren't able to be with you in person. We hope to do so next year. It was a privilege to speak with you today. Thanks again for having us, and we look forward to continuing to engage with you. Thanks again.